Hello, everybody. So this week we have ended the entity structure segment. So we're moving on to another topic. This week we're going to talk about the premium tax credit, how you can take advantage of it, how it can become an issue, and things to consider if you're going to be signing up for health insurance. So the premium tax credit stands for the health insurance premium tax credit, PTC. It's you get it by signing up for health insurance through your state's health insurance exchange. This is otherwise known as Obamacare. Um, I don't even remember what the actual name of the act was at this point. But basically, the way it works is you sign into your state exchange. Every state has a different mechanism for that. There was a federal example basically passed out that a lot of the states adopted, and then some states did their own thing. But all states have an exchange that was required by the act. And so you log into your exchange or you go through an insurance agency and they help you guide you through logging into the exchange, picking an insurance and signing up for it. So when you pick an insurance through the health exchange, you are required to estimate what you think your next year's taxes are going to be. So for example, let's say you're signing up for health insurance in December of 2025. Well, the health insurance will take effect as of January 1st, 2026 and run through December 31st of 2026. You have to estimate what you think your taxable income is going to be for that year, because if you have a low estimate, basically some sort of level just above or just below the poverty line, you are going to get a deduction or a reduced monthly premium on your health insurance. It can be so reduced that you pay nothing. Okay. If you estimate your taxable income very high, I don't remember the exact percentages, but I think it's something like 400% of the poverty line, then you're not going to get any reduction in your health insurance premiums. Okay, so biggest takeaway on that is if you estimate low, you're going to have more cash in your pocket on a monthly basis. If you estimate your income is going to be high, you're going to be required to pay higher monthly premiums, and so you will have less cash in your pocket on a monthly basis. Why is this important? So then we get to the end of the year, and now it's time to file your taxes. Well, there is a form on your tax return. First, you're going to get issued the 1095-A from the health exchange that's also filed with the IRS, and we cannot actually file a return for you, nor can you. If you file it, it will get rejected if you don't actually include that 1095-A on your tax return. Your return is considered incomplete and it's kicked back. The IRS has on your account that you're required to have a certain form included on your tax return in order to file. It requires the 1095-A to create that form. That form is a reconciliation between your health insurance premiums, the reduction that you received, and what your actual taxes were for the year, because at the beginning you estimated it. Well, now we actually know what your taxes are. And so then there's a reconciliation between the estimate, what actually they were, and are you going to owe back some of that reduced premium that you received because you estimated your income too low, or you're going to get a larger refund because you estimated your income too high. So when signing up for health insurance through the health exchange, everybody asks, "Hey, what should I put down as my income?" I don't know. Unless you're a W-2 employee, then you know you're not receiving a bonus or a pay increase or a promotion in the upcoming year, you have a pretty good idea what your income is going to be. Same as last year using your W-2 wages. Put that in there. If you own a business, if you're expecting a large bonus or if you're expecting a promotion, Who knows what to put in there? It's a complete estimate. That's why we call it an estimate. It's an educated guess. And based on your educated guess, you may or may not be receiving a refund or owing taxes at the end of the year. Now, everybody thinks this is a tax. It's not really a tax. It is a credit that basically the way it's working is you are getting a tax credit prepaid for the entire year to lower your insurance monthly insurance premiums. So that's why your insurance premiums get lowered. Well, if you didn't deserve that tax credit, you owe it back. If you didn't take enough tax credit, you're going to get more. So the decision is really when do you want to pay it or when do you want to receive it? And not so much what number do I put on the line for my health for my estimated income. And it's all about time value of money, where the basic rule is money in my pocket today is more valuable than it is tomorrow. So if you want to go by that standard, estimate your income really, really high. Then when we file your taxes the next year, we're going to have that reconciliation. And if you were actually deserved, if you had low enough income and you were supposed to get that premium tax credit, you'll get a refund or a reduction in whatever taxes you owe from your business income. If you feel like you would rather, or I think I said that backwards. If you want more money on a monthly basis, you're going to estimate your income low. Then at the end of the year, you will have that reconciliation. You'll have made more money than what we claimed. And so you're going to have to owe money back to the IRS. But then you can put that into a payment plan. You can treat it like a long-term debt. We've talked about interest rates and stuff like that, but you will owe it back. Versus I want to just pay it all right now on a monthly basis with the idea that I'm not going to have a large payment due at the end of the year. So at that point, you would estimate your income very high. Then we would reconcile it on the tax return, and then we will calculate that you were actually deserved the premium tax credit, and you'll get a large refund on your tax return. So those are the things to consider when signing up for health insurance through the health exchange. When do you want your money? When do you expect that you're going to get a credit because you think you're going to make less income? So personally, my advice to all business owners is to estimate your income high and just pay the full insurance premium throughout the year. I say that because typically you're going to end up owing taxes on business income anyway. And unless we are in a declining economy, most businesses grow over time. So the idea would be, well, this was my income level last year. I'm hoping my income level will be this year. And then the following year, my income level is going to be up here. So we have this growth. Well, if you're going to continually have growth, then it's very, very hard to estimate what your income is going to be. So it's easier to just put a high number, pay your full health insurance premium. That becomes a business deduction. So now we deduct those insurance premiums, so you get tax savings for that. And then on the back end, when we file your tax return, it just means you're going to owe less on your taxes because we are able to take advantage of that premium tax credit, which will then lower the business income taxes due. So that's just kind of my 2 cents on the premium tax credit. Hopefully I didn't confuse you by saying the things backwards. Estimate low, have more monthly cash flow, owe at the end of the year. Estimate your income high, pay the full premium every month with a reduction in taxes at the end of the year. Those are your two options. Unless you're just making so much income you don't qualify at all and you're just looking for health insurance, then you don't even have to worry about this because your income estimate's always going to be high. So just consider those things when you're looking at the premium tax credit. I hope this is beneficial for somebody. Typically, open enrollment is third quarter, so October, November, December, kind of bleeds into January a little bit. I don't know the exact dates. Or open enrollment is when you have a substantial life change. You have a change in career, a job, you get fired, you have a disabling event or something happens, then you can enroll in health insurance at whatever time that takes place. But there is a time limit that you have once that event takes place. So look those things up if that's applicable. Hopefully this video helps some people as you look forward to health insurance. Have a wonderful weekend. We'll see you next week.